What's up, guys? Omar here, broker and CEO of Alden Mortgage and Ome Realty. So this is going to be pricing out. We're actually going to be pricing out, comparing two investment type loans. Now, the two major investment type loans is one, it's called the Dscr loan, which stands for debt service covered ratio. Number two is going to be bank statement loans. I don't care how you get your money, I don't care how you do it, but if your money goes into the bank, you got a little bit of a little bit of that WAP just sitting there in your wait a minute, is that what people call it now? Is WAP? Whatever. So if you got a little bit of that extra fedia sitting in your bank account, but we can't account for it, we don't know where it's coming from because Fannie Mae and Freddie Mac don't want to really deal with that shit. But we do have other people that'll go ahead and buy it. We got something that's called a bank statement loan. Now, for the sake of argument, what we're going to do as far as this comparison is we're going to go ahead and do A. Number one is going to be $1 million. Number two, 20% down, which will be $200,000, excluding any origination charges, any title to escrow, all that other good stuff. And then number three, what's number three? What are we going to do with number three? Credit score. The thing is that I'm going to, in the program itself, you're going to see I'm going to put credit score in there. On the DSCR loan, it doesn't really matter. On the bank statement, it does. We do have to go ahead and run a credit on that because the only thing that we're not doing is on a bank statement loan, we don't give a damn about your income. We don't care. Don't give a shit. We just want to make sure there is enough money coming inside of that bank account consistently over the next 24 to 36 months, depending on how where we're at. Maybe if we're going from $1 million to $2 million to $10 million to $30 million, whatever the case may be, how high are we going on the loan value versus the debt value? So loan value is debt value. I don't know why I'm brain farting, but so we're gonna go ahead and just use a 740 credit score across the board, $1 million, and yeah. So we're gonna go ahead and compare those two. Debt service covered ratio. Now, I don't know if you've seen any of my other videos, but we're going to go ahead and talk about debt service cover ratio. I'm going to do very, very basic, okay? Debt service cover ratio, the debt services the amount of ratio, or covers the amount servicing, and then we're going to go ahead and take a ratio in it. Debt, service, and then we're going to go ahead and do the ratio. $2,000 total rent, income coming in. This is what we look at. We do comparables. We see how much the rent is going in the area. $2,000 total mortgage. Your liability, that's how much is going out. We do a 75% vacancy rate, which is 25% for somebody who's not in there, occupied for 75%. But for the sake of argument, let's just stick to the 2 and 2, okay? So you kind of understand this. 2,000, that is a 1-to-1 ratio. Now, if you are at 1,250 total, or 2,500 coming in, 2,000 on a mortgage, now you're at 1.25 ratio, 1 to 1.25 ratio. And then you go in incremental quarters. So if you have $1,000 mortgage and $1,000 rent, but then you go to 1,250, you're at a 1.25% ratio. 1.25 and or above is typically what you want to go to. There are some cases and scenarios that we will go down to a 0.75% ratio. But I just want you to understand what a debt service cover ratio is. Your debt, which is your mortgage, is going to be covered by the service, your rental payments, and then we do the ratio on that. Number two is going to be bank statement loans. Bank statement loans, there's two ways we could go ahead and get around this whole bank statement loans. We could go ahead and take your 12, 24, 36 total months in bank statements. We'll go ahead and do an expense ratio on it. We'll do the total amount of credits versus the total amount of debits. Please let me know if this is going way above everybody's head. Then, as soon as we go ahead and take your total liabilities versus your total credits, we'll go ahead and do a 50% ratio on it, which means that we'll go ahead and deduct 50% off of the total income that is actually coming in, and that will be the amount that we'll go ahead and qualify you for on your mortgage. So if you brought $100,000 in, we'll go ahead and deduct 50% of that. 50% of that will put $50,000. $50,000 will be your ratio on your bank statement loans of how much mortgage a year you're allowed to go ahead and spend. Divide that by 12. That's where you're at. So, without further ado, ladies and gentlemen, I'm going to go ahead and do that little screen-on-screen thing, and I'm going to go ahead and compare these two loans. Let's go check it out. All right, and we are recording. So most of this stuff you don't need to worry about. That's just my job. This is a Fannie Mae 3.2 file. We don't really even use a 3.2 file anymore. We use something that's called a 3.4 file. This is my name. That's the company. I am the loan officer. This is just going to be a scenario type of situation. So what we're going to do is we are going to go ahead and do this as an investment property, occupied 14 days. We don't want a condo. We want a 2 to 4 unit dwelling. We could go more. You could go with a PUD or anything like that, but we're going to go with multiple units. We're going to go to 4 units. Let's get out of here. 4 units. Loan amount, we're going to go to sales price at $1 million. Oops, shit. $1 million, and then we're going to go ahead and do appraised values at $1 million. We're going to go ahead and do an 80% loan to value on that, which brings our total loan amount to $800,000. Now we are in the debt service covered ratio area. So what we're going to do is we're going to go ahead and do the total monthly income is going to be, let's say, 20 grand. Now none of this really matters because there's, I'm just trying to get through this as quickly as possible because it has to fall under the ratios regardless. So we're just going to go ahead and try to skim through this as much. So now we are on the Dscr loan, okay? Dscr, which is debt service cover ratio, this is an option that comes up. We are going to go ahead and go at 0.15 and or above. Wait, that's the 0.15 and above, right? Yeah, let me go ahead and see. Now, I'm going to go ahead and reiterate this again. I will reiterate this until the day I die. Your commitment period, 30-day lock, and this is the reason why we as mortgage brokers and any lenders or whoever is giving you money, we always harp on getting your documents and everything in. And majority of investors that actually we do have on the investment side of things, we have most of their information on file anyway, so we really don't have to worry about too much. But this is very important because you have to have everything funded by this day. That doesn't mean that we get to go ahead and do all the paperwork until this day. No, your paperwork actually has to be done by the 11th, 4 days before this, so that'll be the 7th. So by the 7th, we have to have your closing disclosures out to you. We have to have notary out to you. We have to go ahead and have you sign it. And then once you sign, then this will be the funding day because there's a 4-day waiting period on that. Compensation paid, I'm not going to show you how much I get paid. We're just going to go to borrower paid. But this is also another good point that I should bring up, that whenever you are getting lenders to go ahead and compete with each other, we already have a pre-negotiated rate with all wholesalers. And when we do, it actually goes to lender paid. And then lender paid, this is how much we make off of the rate that we're at. But I just don't like it when people see it. But does it make a difference? Do you really need to see it? No, it doesn't. It really honestly doesn't. If I did $1 million, should I even show? No, fuck that. I'm not going to show. Okay, but yeah, the compensation type, if you see how much we're getting on origination charges, it's not a big deal. It's not the end of the world. We're just competing against the next person. Your total liabilities, your total closing costs will be less regardless if you see it or not, so don't freak out about any of that stuff. Or just think that we're overpaid or whatever it is. But let's go ahead and get a quote and see exactly how much the Dscr is running, and then we're going to go ahead and go from here to the bank statement loan. So Flex, Investor Flex, this is actually kind of a really, really high rate. That really sucks. At our final price of $624, we are going to be at 9%. God dang, that's a lot. Interest rates have increased quite dramatically. Maybe if I put the credit score back at, let's do it at 740, because that's really high. Even on this, we could get better pricing than this. I'm just doing this because this is the only way I could get around not showing too much personal information. So 740 does bring your interest rate down to the 8.75, which is good. And then if you go under, let's see what it will be if we go under. I always hate when it's just waiting there loading. So
You view invalid products, conform and conventional. Why is it giving me? Well, because they don't do anything under 0.15, because it seems too high risk to go ahead and do anything under 0.15. So we're going to go ahead and skip that. We're just going to go over 0.15, and that'll be our debt service ratio. So as you see, credit is pretty important. It'll be 80% loan to value at the interest rate that you're going to be on a investor type of loan when it comes to the debt service cover ratio. Just so you could do your numbers on your side, your total principal, interest, and payment. Now these are just basically rough ballparks. I just made a bunch of these numbers up. Each county is different, your insurance, your all that stuff. But it'll be a total payment of $7,060.27. So your total income, your rental income, will have to be more than this, which is also something that you new investors should also know. We don't get into the investment side, and myself included, because we are going to be making a bunch. We have a ton of debt. And for each property, we're probably making between $300 to $500 per property. So just so you know, if you're trying to get into this world, it's the accumulation of multiple properties. Once you close on this, boom, you got to go to another one. You got to keep buying and buying and buying and buying and buying. And that's why we have something where you go ahead and buy something that's a distressed property. So your initial capital investment that you get is that this $200,000, which you don't buy something right out the gate, you could go ahead and pull that money back out, refinance out of this, get your $200,000 back, let this run its own show, and then go buy another one. Then you go ahead and buy another property that needs help, and then you go ahead and just do the same thing over and over and over and over again. So we're going to go ahead and we're going to go to investment property, 2 to 4 units. 4 units, we are going to go ahead and do self-employed. Now, self-employed, these are people like we're keeping everything the same. So since we're keeping everything the same, we're actually going to go to 24 months bank statement. Everything else stays exactly the same. And so we're at 8.75 off of a Dscr, which was greater than 1.15, 740 credit score. And then if you want to go to bank statements, it's actually a little bit of a better pricing on a bank statement loan. It's actually, well, it costs you $1,120, but you're at 8.5%, same parameters, that's 0.25% less, which will bring your total payment down to $6,917.97, which is really, really good. So this will be something that you would want to go ahead and take a look at whenever you're doing your numbers on getting, like, let's say, for instance, $1 million property. Now you're eventually, after a year of doing this, you should be roughly about $10 to $15 million in total debt. I know that sounds scary, but just remember, it's just numbers. It's money that you didn't have to worry about before. It's just dollars and cents. And you're not the one that's exposed. It's the people you're borrowing that are exposed. And then as soon as you go buy something that is, that needs a little bit of work done, and you fix it, you refinance, and you get your initial investment back, then who cares? Let that property run itself. So that is a difference in pricing between a bank statement. Oh my fucking God. Between a bank statement and a Dscr loan. So let's go ahead and stop recording. So there you have it. The difference between a bank statement loan and a Dscr loan, if you're trying to go for $1 million. And if you have any questions, comment below. Like, subscribe, comment for up to 50% commission rebate on purchasing your next home, because God knows that you're going to need it after all this money you're going to spend. Helps you out on your rehab. That's always good. 50% commission rebate on your next real estate purchase. 0% listing on selling your current home or any mortgaging assistance. Link in the description below. Until next video, guys. Peace.
I don't wanna waste a minute. Don't know when the plans bring it. If you got a glass, fill it. Cause I need it. Money is a in it. I don't wanna think about it. So if you know the song, sing it. Cause I need it now. Take me to a place where the music's loud. I don't wanna think right now. Flashing lights running through the crowd. I don't ever wanna stop. So let's get out. I got money in my pocket. glass, fill it, cause I need it now. Money is a in it. I don't wanna